Good morning. Good morning. Just want to do a little bit of a chart review. Take a look at the way I've set my charts up with this standard deviation bell curve. I'm normalizing time series and periods uh, just using a standard normal distribution. I go from the mean or the zero out to here's your middle, out to the one. So from the 0 to the 1. And so the 1 is the white line up and down. And then from the 1 to the 2, from the 1 to the 2 is the green line. And or the 2 to the 3, which is the blue line. Go from the 2 to the 3. So I'm basically trading from the middle to the 3. I usually trade to the 2 myself, but if it's a great range expansion opportunity, then hold on to go to that third one. But knowing where you are in this normal distribution is sort of vital to be able to trade successfully and to know where the algos are, because if you're inside the middle of the range, inside the one where the bulk of the time is spent in the markets, you're backfilling, you're going up and down, up and down, up and down inside this area. It's only until you can break away can you go to your targets. And sometimes you get a false breakout. Um, but knowing where you are in this higher time frame distribution um, can get you some really good trade locations um, because the algos know where they are. I can guarantee you. I can guarantee you they know where they are. So pay attention to the higher time frame, and then always check your option information. The implied volatility is kind of ridiculous on the options. Like here's the monthly showing that PT1's way up there at 41.64. Totally outside the realm of possibility currently. So you want to kick this down to your shortest time frames and look for those weeklies, just for the see if there is a high strike and what your boundaries are here, because they're much more likely to get targeted and hit and be able to trade. I don't know if you can see this, but there is some light indentation up here showing you your deltas on top. So a lot of these algos will have delta strategies, reversals and breakouts, as well as standard deviation levels. But just having both what the actual um, real volatility is on the normal distribution, to rely on that more than you do anything else, including, the VIX or implied volatility. If you focus on this first, what's really, really, really happening, uh, then you can incorporate what you're seeing here with the secondary derivative information that the other people are getting and sweeten that pie, as it were, by hitting your long strikes or your um, deviation levels going in and out of these ranges. And so the only other thing you can do is separate your RTH session and your IB ranges. So your 1 hour initial balance ranges can be calculated both off the open and the close. Sometimes the ranges are very close together. The close and the open are very, very narrow. Other times they're spread apart nicely. So when they're spread apart, you can get really good trades off of that because they'll leave. Here's your PTIB3 trading to the PT IB3, 3 to 3. But that is extremely pattern repetitive over and over and over. So if they're spread out, you want to trade to those outside levels, is what I'm trying to say. Um, Otherwise, you can see how repetitive an inside range can be once they get a level inside that range. Like right here, the PT line got hit over and over and over. So these make great day trading patterns to trade to. Kicking this up the next notch, you can replace these with RTH session open and closes. So let me change the template. And once you get out of the smaller IB range, you can put that into perspective with your higher time frame RTH ranges. And this is where it can get really fun. You having this uh, metric available day trading, because you can get a lot of levels. Here's 3 levels all in a row here. Look. So keep an eye on your highest time frame, and then try to get some trade opportunities on your lower time frames. But know where you are. Intraday in these ranges will give you some momentum to get to those upper targets. I want to show you the NQ Thursday's price action, and then last Friday for that. So here was the breakout. Range reversal last week. Let me get my calendar out 1 second. I think I'm at the 26th. Yeah, right here. Right here. Right here. I keep saying right here. Y'all are wondering what the hell I'm looking at. Right there. On this big candle. I just circled the wrong one. There we go. Move that up here. Okay. On this big white candle right here, we got that huge breakout, and that was that Korea guy getting his margin call. And then, of course, the market came back, filled the area back in. But this right here was that Vega flip. And I'll show it to you on the options. Bring up the options screen again and change this to the NQ. Put it on the monthly contract. I don't know if I can get to that prior month. Yeah, I don't think I can get back to that day. Well, what happened, let me tell you, is it got to the edge of the first standard deviation on the implied volatility for the monthly contract, and it turned around to go back to the mean. And right here. So it pulled back to its implied volatility standard deviation and then turned back to the mean, came back and hit it the second time, turned back to the mean on volume. I mean, it got down here and they were hitting it hard this second time. This had that big Vega flip, that big candle right there. The traders were trading off of this monthly implied volatility level. So I've seen them, I've seen how this works now, going in and out of these option levels, a few of them. I'm not doing this to trade options. I'm doing this to get futures market trades, because the futures market is like 3/4 the size of the option market. And it's where you want to be if you know how to trade it. Much more profitable. And a lot more opportunities, especially if you can get positioned, knowing where these standard deviation, or this isn't really standard deviation, just same thing, bell curve over time periods. I'm not using, it can't be standard deviation because I'm not using implied volatility. I'm just normalizing the range on a bell curve. But knowing that we've got this ability to measure the market gives us a huge edge of other traders, especially when you know other things that the market does, like how it uses Globex and other indications whether your range is expanding or contracting, knowing how to position yourself where you are relative to these boxes on these various multiple time frames, and do you have room to run, and where is that exactly, and where are you exactly in that picture. The best place to be is going from 1 to 2, or from the mean to 1. So trading to your 1 and 2 is the sweet spot. And so if we want to give ourselves more of an edge, we can just focus right there, up and down. So that's about it. So like I said, it's not rocket science what I'm doing, but we'll see how far I can get incorporating some of these other option data, and I'd like to get the high strikes and some of the implied volatility standard deviations on these various monthly and weekly charts plotted, so that we can get that to match, coincide, confluence with our PT levels, and maybe with delta. And what else if I want my wish list to be? Delta, momentum, delta, strikes, options, as well as cumulative delta. I just want it all, Thank you. Talk to you guys soon. Bye.